With so many available options to save for retirement these days, are 401ks is really the best way to save and maximize your retirement savings? Just because it made sense for the previous generation, is it still in our best interest to continue to save this way? And that's what we're getting into in this video. Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're going to have just a candid discussion on whether or not 401ks are the best place to save for retirement. We're going to cover the danger of tax consequences that could take a chunk out of your retirement income, whether or not the strict rules around withdrawing make sense for investors anymore, new ESG fund laws that may produce lower returns, and just how safe 401ks are from institutional failure. So we got a lot to cover today.
Yes, we
Brian, we do. Brian, I want to start with this. The original intent of the 401k when it was created in 1978 was to supplement the pension plan, not replace it, which is what it's essentially done.
It has.
And I think it's safe to say a ton has changed since 1978.
Yeah.
And a lot has changed in the last 5 weeks. So as the now de facto national policy for, saving for retirement, the government really controls what you can and can't do with your 401k, from how much you can invest to when you're mandated to withdraw the money. And you're also investing into Wall Street and making them more money. So my question here is the 401k an antiquated way of saving for retirement and building wealth, especially considering how many new investment options there are to save, and there are other options that allow you to have more control over your investments?
Great question and great intro here. 401ks are still the top savings vehicle for the majority of workers today. For most, it's going to stay this way, and for good reason. Many people don't want to manage their own investments. Most don't even open their statements to review what they have. We've talked about that so many times, but they just continue to contribute, and that's what they do. That's it. They stop there. So, but the trend is definitely changing for younger workers who want access to alternative investment classes like cryptocurrency, real estate, even annuities. Now, we've talked about annuities on this channel for a long time. Sure. Can you imagine a 30-year-old saying, "Hey, I want access to an annuity"? What? That's mind-blowing to me.
Yeah.
So, but according to a Schwab annual survey of 401k participants, only 37% of Gen Z started investing in their 401k, but 22% of them opened a mobile trading app.
Mm-hmm.
That's the difference.
Yeah.
And over 45% of both Gen Z and millennials want cryptocurrency inside their 401ks. That is a big push for why Fidelity is now going to be offering crypto inside Bitcoin inside the 401k. So this is a massive shift, as we're seeing that these age groups are wanting more control over what they invest in and how they invest today. So,
well, I think it'll be interesting to see how this plays out in the next decade, if 401ks do become a lesser player in the retirement savings game. So we'll see. I guess time will tell, right?
Right.
All right, so moving on to the next questions. 401ks really made sense when tax rates were lower. You make your pre-tax contributions that reduce your current taxable income, and then you pay taxes when you take the money out, right?
Sure.
So, and the thought is, okay, when I retire, I will be in a lesser tax bracket, so I won't have huge taxes to pay.
That's what the thought is. Yeah.
Right. Here's my question, though. How much sense does it make now to save in a traditional 401k today and defer those taxes and then pay them later when no one knows what the taxes were going to look like in 10, 20, or 30 years?
Yeah, we just don't even know. Taxes seem to change constantly based on which party's in office and who controls Congress today. So I think the next one's coming up in 2025. The current tax brackets expire. So we don't know if our tax is going to be higher or lower 10 or 20 years from now. If you're concerned about this, there are options to avoid what people call the retirement tax bomb. And, that's an industry term that refers to the massive 401k tax burden that could hit high income earners as in their retirement years.
Right.
As I said, though, we now have more options to make sure we don't get stuck with a chunk of our money going to taxes in retirement, like the Roth 401k option.
Right.
Make sure to check out our video that we did on that one. So
yeah, we're dropping that in the link below.
Roth 401ks require you to make after-tax contributions, which don't reduce your current taxable income. So you're not getting a tax break today. But if you're willing to pay taxes on your contributions now and want tax-free withdrawals once you reach retirement, the Roth 401k is the way to go. That means you get to keep all the investment growth without worrying about taxes. Plus, since you've already paid taxes on the contributions, your retirement income won't be subject to income tax.
Right.
This can be especially beneficial if you do expect to be in a higher tax bracket in retirement. Me, I hope I'm in the biggest tax bracket there is when I reach retirement. Why? That means that I have accumulated a boatload of money by that time. That's just, that's my goal. So another thing to point out here is the Secure Act 2.0 legislation now allows for company matching to go into Roth accounts. Employers have to opt into this, though, so you got to be careful. The issue with the Roth option is how many actually use them.
Yeah.
According to Fidelity late last year, more than 75% of companies offer a Roth option, Michelle, but only 13.6% of employees actually use them.
Yeah, that's a staggering number. So question here, what if your plan doesn't have the 401k Roth option?
Okay. Currently, up to 75% of all plans do. And this is going to continue to grow. I mean, This is the new legislation that just came out in the last 2 years, so a little time to get it up and running. But if your company doesn't, ask them if they can add one.
Yeah.
If not, in my opinion, add to your 401k up to the traditional company match. Then take and invest elsewhere in the additional funds you have, like invest in a Roth IRA if you qualify based on your income.
Right.
You can't save as much, but you can contribute regularly and let it grow over time, and you can take that money out tax-free in retirement.
Okay, in 2022, the Biden administration started pushing for savings to be put into ESG funds, also known as sustainable or impact funds.
Yep.
Last year, Biden's Labor Department announced the rule change that went into effect at the end of January 2023 that would allow fund managers to invest your money in these funds. And then in March 2023, last month, Biden used his first veto that would keep the rule in place. So there are two pending legal challenges that may complicate efforts to keep the veto in place, but for now it stands.
Right.
So it's important to note that this new law, until this new law, I should say, the law required fund managers entrusted with 401k savings to invest the money where it was expected to get the most profit, right?
Mm-hmm.
Makes sense.
Yeah.
Now it appears that the definition of what's best for the client may not be what's in the best interest of the client, right? Yeah. So I want to pull up something really quickly, and this comes from NerdWallet, so just give me just a second.
No problem.
All right, so you can see it on the screen here, right? All right, so it says here, fund managers are beholden to a fiduciary duty, meaning they legally must choose investments in the best interest of their clients. Without Biden's veto, best would have strictly meant best performing. And while best performing is certainly less squishy definition than best when it comes to investing, ESG investments propose what's best should factor in risks such as climate change in addition to financial returns. So, oh boy. Yeah, right? So Brian, let me get my breath here. Am I reading this correctly? This law now allows fund managers to invest your money in stocks of companies that favor environmental policies, even if they earn a lower return, because it's not just about profit, it's about profit and environmental conditions.
Yeah, that's exactly what's going on here. And it really bothers me. I'm a fiduciary and have been for decades. My clients dictate where they want their money invested, not the SEC, not fund managers, and definitely not me personally. If a client wants ESG funds, we go get them and we go find them the best ones. It's that simple. Same with bonds, stocks, and any other investments that the client wants.
Sure.
If the client tells me, Michelle, that they don't want Philip Morris in their portfolio because of the dangers of smoking, we don't buy it. The client dictates the investments. We just facilitate their wishes as a fiduciary.
Okay. So for further clarification, if I find out that that a fund manager has me in an ESG fund that's not performing well, does the manager have to move me out, or do they have the right to say, no, you have to stay in this crappy performing fund because it's what's right for the environment and because the government told me so?
Honestly, I don't even know how to answer that. Each manager may interpret the law in different ways, and you don't know what they're thinking. Okay, my thoughts are, if you don't want to invest in ESG funds, tell them to get you out of them. Remember, this is your money, and the manager has to invest based on how and what you dictate, not what they want to do.
Right, right. Well, before I switch topics here, this is another reason that everyone should be opening their statements and engaged with their 401k if they
Know
currently
what you're invested in. It's that simple.
Right, exactly. Okay, so we can breathe and we'll just take a deep breath here and move on.
Yeah, it kind of upsets me on that one.
Yeah.
As a fiduciary for 20 some years now, it's like, no, I'm sorry. It's about my consumer. It's
Sure.
not about some regulation that says I have to invest money here because it's good for the climate. I'm just not there.
Well, and if that ESG fund is performing really well, like great.
That's
but the whole
great.
point of saving is to maximize your returns and as much profit as you can so that
You're
you have
exactly
money
right.
to live on later.
As long as the client says it's okay.
Sure.
When I sign in here as a registered investment advisor, fiduciary, I have to sign a document with my client. My client and I have to agree on where we're investing funds. And in that disclosure, it states, is there something that you do not want me to invest funds into?
Right.
If they put ESG, if they put tobacco stocks, if they put gambling stocks, anything like that, I can't invest them.
Sure.
It's that simple. I have to go with what they say. That's the rule.
Yeah. Well, maybe not anymore. We'll see. All right. So let's move on. 401k investors are limited to how much they can invest, and there are penalties for accessing that money early. And at the end of the year, that money, the year that money comes out, it's now taxed as ordinary income. That can hurt.
Right.
So obviously, it's not ideal to touch what you're saving for retirement, but we live in a world where sometimes people need to access their funds, whether it be due to financial hardship or because they want to invest in real estate or even buy a house.
Sure.
So should those with 401k be thinking of also saving somewhere else, somewhere where they can earn pretty good returns, but also pull the money out if they need or want to, some vehicle that has greater flexibility than the 401k, but isn't a basic crappy savings account?
Yeah. First things first, you should have an emergency account that is liquid, that will help carry you through hard times if they arise. And if you have one that's well funded, you won't have to worry about tapping into retirement accounts at all. Okay. Next phase is then possibly a Roth IRA if you're saving for, let's say, real estate or another specific goal, as it's going to give you some of that liquidity that you're trying to get.
Okay. All right.
Each type of account out there, from 401k, Roth IRAs to high yield savings accounts, whatever, they're designated for a certain thing. Sure. Use them based on what your goals are with each one of them. So,
okay. All right. So with the fallout of Silicon Valley Bank and others last month, or whenever it was, a few weeks ago, people are nervous, and rightfully so, about losing their money. Are 401ks SIPC protected, even if it's held at a brokerage firm like Fidelity or Vanguard?
Yeah, if you go to the SIPC's FAQs page, your frequently asked questions page,
we will drop that link below so you can go look at it for yourself.
Yeah, I want you to read this because here's how it reads. Many people don't understand this, and we're hoping this brings a clearer definition. If your employer's 401k plan assets are held in a customer brokerage account at an SIPC member brokerage firm, then cash and securities in that account may be eligible for protection by SIPC. Protections limited to the amounts available with respect to a single account. However, an overall limit of $500,000, of which no more than $250,000 may be for cash. SIPC protection is not available separately for the individual participants in the 401k plan.
Interesting.
What this means is if ABC Company had a 401k plan with 50 employees and they set up everyone under one single brokerage account, then those 50 employees would have to share in the $500,000 SIPC limit. However, it depends on how the plan's set is actually set up.
Okay,
Let me
so
let me add one more thing there.
yeah.
This channel is not about selling fear.
Mm-mm.
This is about giving you the true facts of what's going on with your retirement accounts. So that may sound alarming, what I just read to you, but it's the actual facts, and we
Right,
have
we
to
didn't
give you
make
that
that up.
information. Yeah, yeah. It ain't. Hey, no, it's not covered. You're gonna lose all your money. No, I didn't say that. So
Yeah, no, well, yeah, and we are going to put that link below. Go read it yourself.
yeah, definitely.
Okay, so if the 401k is not SIPC insured, if your 401k, then who backs up these funds and keeps them safe?
Okay, so let's go to the ERISA, which is the Employee Retirement Income Security Act of 1974. Okay, this is a federal law that sets minimum standards for most voluntary established retirement and health plans in private industry to provide protection for individuals inside these plans.
Okay,
It made a law where your 401k must be held in a trust, separate from the employer, separate from the plan sponsor,
okay,
separate from me as the advisor, and even separate from the trustee or custodian. This stops each of them from having access to your funds. There's your protection.
got it. Okay,
This covers the funds that you add, the matching funds that your employer adds, and any gains that you have in the market.
okay.
Note though, this does not mean that your assets are protected against market risk. That's the key.
Aha. Okay. But I'm just going to repeat that. So it covers the funds that you add, the matching funds that the employer adds, and any gains that you have in the market.
Yeah, it puts that level of separation between your bucket of money over here and everyone else involved. It's you and your money, and then everyone else on the outside looking in.
Got it. Okay. Listen, if you have found value in this video, hit that like button, help us grow this channel, share this video with anyone you know. You got colleagues, let them, this is really important information. Things are
Sure.
changing very quickly in the financial landscape, economic landscape. Know what's going on, know what you're invested in. So that's important. Please share, comment, like. All right. And also, Brian mentioned it earlier, we're going to drop a video that dives deeper into what Brian talked about earlier with funding a Roth IRA, Roth 401k rather than the
Yes.
traditional 401k. So do check that out. It'll be in the pinned comment and the description below this video, along with the other links we mentioned to the NerdWallet article and the SIPC.org investor facts page. Oh boy, that was a mouthful. Okay, so Brian, before we wrap this up, anything else you want to add? Because this has been a long video, but I think it's been an important one.
Let's go back to, let's keep things simple. My number one rule is know what you're invested in.
Right.
Okay, it's that simple. Today's technology allows you to, at any given moment, know exactly what you're invested in, get real-time notifications of what's going on. You know, I know every fund that I'm in, what that fund's invested in, because you get notifications of how they invest. And then I know every stock that I buy. I know what's going on at all times with my portfolio. Not because I'm a financial advisor, because I'm concerned about my money. I want to know what my money's doing. You should also spend some time learning the facts behind what's going on with your portfolio. Know what you're invested in. That's
Absolutely.
simple.
Well, it really boils down to taking responsibility for your money and your
Right.
financial future, right?
You got one chance at it. Let's do it. Pensions are gone for the majority of United States, people in the United States, but this is your one chance to make it happen.
Okay. All right. Like, comment, subscribe, do all those things. And thank you very much for watching. Thanks, Brian, for everything. So until next time, everyone, we'll see you then.
Thanks, everyone. Have a great day.